What's going on, guys? In today's video, we're going to continue to help fully diversify my portfolio by adding two more companies, and they'll be in two different sectors. If we scroll up here, we can see that overall I want to have 5 companies in each of my 12 sector pies. On the left here, you can see that I'm happy with my diversification in terms of those 8 pies, but we still have 4 sectors that we only have 4 companies in. So we need to add 1 company into each of these 4. So today we're going to focus on my consumer staples and also my industrial sector pies. Firstly, just to give you a bit of an update of where my portfolio is currently at, we currently are now at over €5,000, which equates to about $6,000 or so. We're up 9% or €415, again, which equates to about 500 and something dollars. And also, just one point to note, that the companies that I've been adding in over the past week or so, I still haven't invested in some of them, but I've set them up in the pies. So once after this week, once we are fully diversified across all 12 of my portfolio pies, next week my plan will be to start drip feeding funds into all 12 of these sectors. So let's start with my consumer staples pie. Today we'll be adding one further company. We currently have €210 invested and we are up over 5%. We currently have 4 holdings in the form of Coca-Cola, which is up 8.24%, PepsiCo, which is up 7%, P&G is currently down 0.72%, and Walmart was one of the companies we added in at the start of this week. And as I stated earlier in the video, we haven't invested into these companies yet, but I will be doing so next week. The company that I'll be adding into my consumer staples pie is a company I found very interesting, and I believe certainly is the way forward once the population kind of continues to grow and the supply of meat maybe starts to run out a bit. And again, I just want to note here that I'm not a vegetarian or anything like that as such, but I do find the company quite inspiring, and I really do find it one of the more interesting companies out there, and that is BYND Meat. We can see here that the company sells a range of plant-based products across 3 main meat platforms of beef, pork and poultry. The company's current CEO is Ethan Brown, and they currently have 472 employees, so it's probably one of the smaller companies in terms of my overall portfolio, in terms of employee size. Their headquarters is in the US, and their sector is in consumer or non-cyclical, and industry is obviously food processing. In terms of some of their key ratios, again, as they're one of the newer companies, a lot of this information still isn't up on Trading 212. But the market cap is currently at $8.56 billion with a revenue of $297.9 million, and they currently have an earnings per share of minus 22 cents. In terms of BYND Meat's financial summary, we can see over the 39 weeks ending 26 September, their revenue increased 53% to $304.8 million, and also their revenue reflects an increased demand in the company's products and services due to market conditions. We can also see that the higher net loss reflects general admin fees increased from $40.3 million to $86.5 million, and the research and development increased 38% to $17.9 million. Now obviously, I know what you're thinking. You might think that some of their expenses are quite high, but again, as this company was only formed about 8 to 10 years ago, they really do need to spend a large portion of their profits on research and development still, as they're still in the kind of early stages of development. In terms of their income statement and balance sheets, we can see here they have a revenue of just under $298 million, with a net income of minus $12.44 million, with a profit margin of minus 4.18%. And again, that's solely due to the kind of research and development side of things and trying to increase the size of the company due to demand also. So again, I would kind of take these figures with a pinch of salt as such, because they're not like, let's say, Coca-Cola that are around years and are already completely set up. BYND Meat are still in the development stage, and they do need to do the research and development and continue to grow in order to survive long term. We can also see here with their balance sheet that the total assets are currently $451 million, with total liabilities of $67.83, which gives them a debt to assets ratio of 15.1%. We can also see under cash flow that their operating amount is currently minus $47 million, investing is currently minus $26 million, and they have financing of just under $295 million. And yet again, without repeating myself, that a lot of this again is down to research and development and trying to extend their business for the long-term success. On Beyond Meat's 1 year chart, we can see that they're up 83.35% over the last year. And again, that's due to their kind of recent development and expansion of their company. This time last year, they were sitting at about $77 a share, had a nosedive in March down to about 53, so they had quite a large drop. But since then, overall, they've gone on an upward trajectory, and they even reached highs of about $188, and they had a bit of a crash then down to about, let's say, $140, so it went down about $40 in that space of time between, let's say, October and November. But again, since, let's say, November 15th, they've kind of went in an upward trajectory and up about 9% in that recent period again. So overall, like again, even when a long-term investor, you really need to realize that it's all about kind of dollar cost averaging. So no matter what price I buy in at, let's say I did buy in at 189 or 190 again, which I didn't, but if I did, then if I was buying it again, it would have been down around here. So like it's all about long-term kind of dollar cost averaging, and when the company does go down in value, you kind of need to take advantage of that, and we're going to see that especially in the next company I'm going to be mentioning as well. But before we get into that second company, let's first add Beyond Meat into my consumer staples pie. You can see now, by adding it in, we will have 5 companies: Coca-Cola, Pepsi, P&G, Walmart, and now Beyond Meat. And we can see here, based on a 5-year historical market performance, on average, we'll be getting around 16.26% increase in my investment, which certainly I'd be happy with. And again, this is historical performance, so what happened in the past doesn't necessarily mean it will happen in the future, but that just gives you a rough estimate of where we're kind of sitting at right now. And the second company that we're going to be adding today is an industrial sector. We currently have €220 invested here, and we're up just under 10%. We have 4 holdings as of now: 3M, which is up 8.37%, Caterpillar is up 20%, Waste Management is up just under 8%, and FedEx is one of the new companies added in earlier this week, so we have yet to put any capital into this investment. And the company that we're adding in to my industrial sector pie is Boeing. And again, a lot of people will probably be saying, hang on, because of the virus, etc., this company has been hit extremely hard. But when you need to realize that this is a long-term investing, and Boeing is a company that will definitely bounce back in the long term once travel restrictions ease and things go back to normal. So again, you can't really think short term when you're investing in a long-term portfolio. So you need to kind of take advantage of such scenarios as of now. And I think Boeing is definitely undervalued. And again, in the next 5 to 6 years, I believe this company is going to be back to where it was pre-coronavirus levels. The company is an aerospace firm. It operates in 4 segments. It's commercial airplanes, defensive, space and security, global services, and Boeing Capital. We can see that their segment develops, produces, and markets commercial jet aircrafts and provides fleet support services principally to the commercial aircraft industry worldwide. Even when we look at the 1 year chart later on, you kind of got to realize that you'll only be drip feeding money into this stock. So let's say we bought at, just to make it simple, $10 a share. Well then, let's say if it fell to $8 or $7 a share the week after, then because you only put in a minimal amount of capital at the start, we'll be dollar cost averaging quite well at that stage. So again, it's all about kind of drip feeding in money and dollar cost averaging over the long term, and patience is definitely key to long-term success. So Boeing currently has 161,000 full-time employees, and its headquarters in Chicago. Their sector is capital goods, with their industry being aerospace and defensive. In terms of some of their key ratios, we can see their market cap is currently sitting at just under 113 billion. Their PE ratio is 24, with revenue of $84.8 billion, and they have an earnings per share of $8.32. In terms of their financial summary, it doesn't look too pretty, to be honest, but again, you kind of need to emphasize that this is long term, and you need to take advantage of dips like this, especially in blue chip companies such as Boeing. So in terms of the 9 months ending the 30th September, Boeing's revenue decreased by 33% to 42.85 billion, and the net loss of common stakeholders totaled 3.45 billion versus income of 371 million revenues, and that's reflected in the recent commercial airlines segment decrease of 54% to 11.43 billion, global services segment decreased by 15%, total defense, space and security segment decreased by 4%, and United States segment decreased by 51% to 5.19 billion. So as you can imagine, if I was already heavily invested in this company before the crash, I wouldn't be kind of too happy. But because I have none investments at the moment in this company, and because they're down, let's say for example here 33% in the last 9 months, this really does pose a great chance to dollar cost average it, and over the long term kind of see your profits grow as the company kind of comes back to normal. In terms of their income statement and balance sheets, on the income statement the revenue is currently 84 billion, net income is minus 636 million, with a profit margin of minus 0.75. If we look at the balance sheet here, their total assets is 133.63 billion, with liabilities of 142.25 billion, with a debt to assets of 106.45%, again, which is quite high, but you need to realise the circumstances behind the company as well, and also because of the current market situation. Boeing's cash flow is currently operating at minus 2.45 billion, investing is minus 1.5 billion, with the financing currently sitting at 5.74 billion in positive green. When you look at their 1 year chart, it really isn't a pretty sight at all. They are down about 41% since this time last year, again, which poses a great opportunity to get in at a dip. It was $373 this time last year and had an extreme nosedive down to under $100 in March. But you can see since then it has kind of went in an upward trajectory overall when you kind of exclude this part here, and is up to about $218 at the moment. So when you actually take, let's say, March out of the equation and you just focus on the last 3 months, you can see that the company is up 22.5%. So it's kind of starting to come on the mend a bit. Again, kind of due to the virus kind of stabling out a small bit, and the market economy kind of getting used to the terms with this. And let's say Boeing is kind of rebuilding as such after this extreme kind of downward trajectory in March. So in the last 3 months, we see it went from $178 a share to $218. So it's up about $40 a share in the last 3 months. And again, in the long term, again, we've seen the 1 year chart here, it's still in the red, obviously because of the crash. But again, in the next few months, I believe that they're going to continue to go on an upward trajectory. And again, even if there is a dip, we believe that in the long term, the next 3 to 5 years, that the company is going to be above its pre-coronavirus levels of the $300 mark and even beyond up to the 400s. By adding Boeing into my industrial sector pie, we now have 5 holdings in the form of 3M, Caterpillar, Waste Management, FedEx and Boeing. And based on a 5 year historical market performance, on average we'll be getting about a 7.19% return. So by adding those 2 companies into my portfolio, we now only have 2 sectors where we need to add 1 more position into each, and then it'll be completely diversified across all 12 of my portfolio pies. So in tomorrow's video, we're going to be adding 1 company into my healthcare sector and 1 into my communication services sector. Again, we will then have full diversification across all 12 pies. And then next week, after we do my portfolio update on Friday, we'll look over the weekend then to picking what companies that I'm going to be investing in, as in putting the capital in next week, and what portion of each will be going to each of the companies that I've added in over the last few weeks. So that'll be quite interesting to see also. And with all that being said, that brings the end to today's video. If you found the video anywhere helpful, please consider smashing that like button. And again, if you're new around here, please consider subscribing to the channel, as we're only 5 subscribers away from our next goal of 450 subscribers. And also, more importantly, comment below if you have any suggestions, questions or ideas on my overall portfolio. And if you think I'm over diversified, or do you think I kind of have hit the nail on the head as such. And do you hold any companies that I don't, especially some blue chip companies in any of the 12 sectors that are in my portfolio. So thanks very much guys, I'll see you in tomorrow's video where we'll be adding in my final 2 companies.